Is there a difference between velocity banking and infinite banking? Are they the same or is it different? And which one do you use? Let's dive in right now. Hello, my fellow Ripplers. This is Chris Miles, your cash flow expert and anti-financial advisor. This show is for you. You've worked so hard for your money, and you're now ready for your money to start working harder for you today. You want that freedom and cash flow now. You want to become work optional, where you work because you want to, not because you have to, because you have enough passive income coming in that allows you the freedom to work or not work or do whatever you want to do. And it's not just about doing whatever, right? It's not just about getting rich. It's about doing what you love with those you love and living a richer life by blessing the lives of those around you. That is what it means to create a ripple effect today. Thank you for tuning in. Thank you for being part of this show, because without you, I couldn't create this ripple effect as well. And by the way, this show just keeps growing and growing. More of you are following us on YouTube. More of you are following us on the podcast. There's more people listening there. Thank you so much for being a part of this. I take this very seriously. I never want to disappoint you. I always want to make sure we give you the best value possible. And thanks for those that have reached out. Special shout out to those of you that have also reached out. Many of you have been reaching out recently because you want to figure out, how do you create the passive income now? How do you become work optional? The best way to figure out whether that's for us or whether you're for us or not is to go to the passive income calculator at moneyripples.com. You can actually put in your numbers there. It's about 10 questions. You put in your financial numbers and it will tell you how much passive income you could be creating in the next 12 months. So go try that out today at moneyripples.com. All right, so let's talk about this whole velocity banking, infinite banking. I've heard a lot of people use it interchangeably. They are not the same. I will just come out and say that they are not the same at all. So let me define what each of them are, but also when do you use which one and for what purpose? And especially, what are the dangers? I'm seeing so many people be careless with some of these strategies, and you need to be warned of that as well. So be sure to tune into the end, because we're going to dive into that today. All right, so first and foremost, I'll start with infinite banking versus velocity banking. I couldn't even say that, did I? Infinite banking versus velocity banking. So infinite banking is that strategy we talk about using with whole life insurance, right? We are using a strategy where you're constantly moving your money, flowing it in and out. It's a strategy. Infinite banking is merely the strategy, while whole life insurance is the tool, the vehicle that you use to do that. Now, when we talk about infinite banking, we're often talking about how you can double dip, make money in two places at once. And yes, you can leverage it. You can borrow from the cash value. This is the tax-free savings account that's a part of it. You can borrow from that to use for whatever you want. It could literally be used to pay down debts. It could be used to save up for tax bills each year and try to compound a little extra interest along the way. It can be used as well to save up for retirement, save up for college savings, to honestly save up for real estate investing like we talk about. And again, get your money working two places at once, because you're able to leverage the cash that you have, but use the insurance company's cash while yours is there as collateral. And you can take their money, invest it, and then make money from your investment while your money's also compounding on the side over here. That's what we refer to as infinite banking, using whole life insurance specifically, not indexed universal life. It was never meant for that. Even Nelson Nash, who created the concept, said that doesn't work with that, because they're not exactly the same. There's a lot of different access to liquidity. It's just not as liquid when you use those kind of strategies. Now, there's also velocity banking. Now, velocity banking is referring to using a home equity line of credit. This is using a mortgage, not using life insurance, using a mortgage. So when they talk about velocity banking, what they're talking about is you get a line of credit on your mortgage, right? And now when you get this line of credit, usually when you get a mortgage, a 30-year mortgage, let's just say a simple mortgage like that, you pay a steady payment. It's always the same payment every single month. Now, as you pay that mortgage payment down, does the payment go down? No, it doesn't. This is why many people are saying, why don't we switch to this Australian method? I remember hearing about this literally about 2008 or 9. So it's just starting to show up in America. It was kind of the whole system where they say we can pay down our mortgage faster by having this line of credit. Now, there's different people using this in different ways. The traditional way, the Australian type of way they were talking about doing, is your first mortgage is a line of credit. Now, here's the good news with having a home equity line of credit. As you pay that mortgage balance down, the payment also decreases as well. The nice thing is that when you pay it down, if you need access back to that equity, you can pull it back out. Understand, if you have a normal 30-year mortgage, You can't do that. If you pay extra onto your mortgage payment, it's gone. It's in the hands of the bank or the mortgage company, and you're never going to see that money again. But if you have a line of credit, let's just say that your house is worth 500,000 and you have a 300,000 line of credit and you've paid down your mortgage to $200,000. Well, if it's a 300,000 line of credit, you can then pull out another $100,000 of that line of credit, right? If it's a $400,000 line of credit, it means you can pull out a few $100,000 out of it and then pay it down. Again, the payment will go up if you do that. So it's a variable interest rate most of the time. There are some fixed ones, but they're higher rates for sure. You can pull it out, but it could be a variable rate. And also the other thing is too, is that the payment does vary as well, depending on the interest rate, also depending on the balance. So the great thing is you can pay it off aggressively, saving yourself potentially some interest, but you can also run it up. Now, here's where they are the same: infinite banking, velocity banking. The one thing that's taught between these two strategies that really when you deal with loans that are lines of credit like this and you're paying down at least interest only, they only charge simple interest. Now, if you've seen me do other master classes, and if you haven't subscribed to our YouTube channel, be sure to do that because we've got a lot of master classes on there you can look up if you go under the live section of our channel. And there's been from time to time, I'll bring up when we talk about infinite banking, I'll bring up about compounding interest versus simple interest, right? Compounding interest, we always see it, right? Like people misquote Einstein saying it's the eighth wonder of the world, right? Compounding interest, as time goes on, it goes up, up and away. So for example, say you have a $400,000 mortgage, 30-year fixed, you're paying 6% a year on it. Many times people will show you the amount of interest you pay over the life of that loan. I remember as a mortgage broker, I did the same thing. I'd say, look at this. You're going to pay, in addition to the 400,000, $463,000. That means you're going to pay $863,000 over the life of this loan if you pay just the minimum payment. That's like paying two mortgages. So if you want to stick it back to the bank, pay it back early. But here's what I didn't understand is that that's true on one little level, but your money doesn't work on just one level. There's always moving parts and pieces that you can recapture dollars. And so I would also, now what I started to learn later, I was especially shown this and it blew my mind. I said, well, what if I had the $400,000 today to pay it off? But instead of paying off, I'm actually going to eat that $463,000 of interest over the next 30 years. But I'm going to take my $400,000 and invest it. And what if I put it in a huge, awesome investment of a CD, pay me 3% a year, right? Now, obviously, 3% CD compared to a 6% mortgage, you'd think you're going to get your butt kicked, right? Because obviously, if 6% is 463,000, I'm probably going to earn less on a 3% CD on 400,000 over the next 30 years, right? Wrong. Check this out. Look at this. With that 400,000, it grows to 970,000. You earned $570,000 of interest over those same 30 years at 3%, earning half the interest rate. 570,000 is 100,000 more than the 463,000. How is this possible? Because your money compounded while when you make payments and you keep the balance from growing on you, especially when you're paying principal and interest on a mortgage, it's simple interest, right? This blew my mind. It's even crazier. Watch what happens if you just earn the same 6%. You now earn about 1.9 million in interest while costing you 463,000, right? That means you still net just a little under 1.5 million. Do you think I care about that extra 463,000 if I knew I could make 1.9 million? You probably wouldn't either, right? This is important to know. This is what they teach in the velocity banking. Now, with velocity banking, you use that home equity line of credit. Of course, as you pay it down, you save on interest. You can pay it down faster. And they'll even say about taking your paychecks. Your paychecks go and get deposited into this account. And then, of course, you start bill paying from it. So what it does, it brings down that average daily balance that they charge interest on. It makes it so that less interest is being charged on a month-to-month basis. Now, this has been a very debated topic, right? Because based on a calculator, it's brilliant. And this is why they'll say, yeah, you can pay off your mortgage in 7 to 10 years. Now, I'll tell you this. Here's a warning. Here's the good, the bad, and the ugly that I see with velocity banking is that every scenario I see, it's always that someone has extra money left over every month. It's like, hey, you make $5,000 a month, but you only spend $3,000. And so here's what happens. Well, all they're saying is you're adding the extra $2,000 a month to your mortgage payment in that example, right? That's what they're really doing. They're like, you just leave it there and you can pull out whenever you want. Here's where I have a problem. Despite what the calculator says, real life doesn't always reflect in the calculator, does it? You ever seen those commercials? Life comes at you fast, State Farm or whatever it was, or Allstate, I don't remember. They always talked about that kind of stuff, right? Well, we all know that life can happen, right? I don't even necessarily believe in Murphy's Law, that anything bad happen will happen. I don't believe in that necessarily. If you've been following this podcast, you're probably looking for great ways to create passive income right now, right? Well, we got you covered here with Central Lending. Central Lending specializes in alternative investments that actually are designed to create steady returns and long-term financial security for you and your family. Now, they prioritize transparency. They love, building those strong relationships, giving you that confidence and peace of mind, knowing that you have your money working harder for you, so you don't have to work so hard for that money. You want to learn more how to do that? Go to centrallending.com and check out what they've got today to create your passive income and wealth creation right now. However, the truth is that things do happen. For example, what if you do have something going on in your life? Now, they'll say you can pull money back out, but what if the bank changes their mind? What if the bank says, you know what? I know you've got this $400,000 line of credit. You've paid it down to $200,000, but we're starting to see some stress because recessions come up. By the way, whenever there's a recession, banks get tighter on their lending. They get a little bit more, they try to save themselves from all the risk because banks are usually hurt the worst during recessions, or one of the worst, not always the worst, but they are definitely affected in every recession. Therefore, what are they going to do? They're going to say, you know what? That $400,000 line of credit, even though there's $200,000 you could probably access, we're not going to let you access it. We're going to knock down your balance down to 200,000. Now, I've had a lot of people, I shouldn't say a lot. I've had a few people, they're usually younger, they're usually selling this velocity banking strategy say, well, that just doesn't happen. I literally watched this happen in 2007 and 2008 and 2009. During that previous recession, banks literally did that and they gave you zero warning. I had one client that had an 84,000 line of credit. She owed 42,000 on it. So about half, right? Well, her plan was, we were already talking about it. She's like, I think I'm going to go get some other additional training to get a certification that allowed me to make some more money. It was like only $6,000. I mean, very, very tiny investment for a certification. So she was going to use her line of credit to pay for it. Guess what? She goes to use it and she realizes it's not there. She doesn't have access to it because they knocked down the limit down to 43,000. She owed just over 42. They knocked it down to 43,000. They made the limit down to where her balance was. So she's like, wait a minute, all that home equity is now trapped, which by the way, we know what happened when home equity got trapped, like what happened to me. We couldn't get to it and eventually couldn't even sell it for what we owed. And of course, we ended up, foreclosing on our property because the value came down. Even though I had lots of equity in the property, because the values came down, I didn't have access to that equity, especially when there was a cash crunch. So understand a home equity line of credit, just like any credit card or anything else, does not count as emergency savings. Do not think that that's somewhere you can just get money whenever you need it. It's not liquid. It's not accessible when the banks don't want it to be accessible. So this is the biggest risk that I see. So remember, velocity banking, they can always cut back those lines of credit, and all of a sudden now your money's trapped in there. This has happened too many times with so many people, and I believe it's going to happen again. Now, I already know there's another company out there that some people have reached out to us. They're like, well, I'm looking at some of these other companies that do coaching like you guys. This one that does velocity banking. By the way, it's their one trick pony that they have. I said, yeah, go Google them. They got a class action lawsuit against them. Why? Because it wasn't just the fact that the limits came down. In fact, that hasn't really happened necessarily for these people. What hurt these people was the thing I warned about years ago on this very podcast. I actually warned it since 2020. Is what happened was this, is that people went and they invested it in some other high risk type of investments, things that I would never let our people touch. Not that I could stop them, but not something that I'd say, oh yeah, that's a great deal. So they were connecting with high risk investments. They lost money, but guess what? They were using their home equity to go invest in those things. And because they lost money, now they have to make a payment on their home equity line of credit with zero cash flow coming in. And that's also a big risk. A lot of times when my clients were talking about, and this is back when rates were lower, we're not talking about it as often now. We're very careful, with the higher interest rate environment we're in now. But even when they were lower, I would often warn clients. I said, listen, you probably want to go into something that actually has legitimate, something backing it up, real value, like an actual real estate property. And I would even tell them, listen, even if you're debt adverse, the good news is you can always take the debt from that house, like your own house, and go buy a property. And now you have equity in another property. It's just putting your equity in different places, but now you can have more leverage of that money. That can make sense. But remember, there's always risk, and you've got to make sure that there's cash flows to support the monthly payment, or you've got enough of income coming in to support that payment. That's what happened. These people were literally gambling everything on the strategy when interest rates went up because it's a variable rate loan on this velocity banking, right? When the interest rates go up, what happens? Of course, now the money you're making as a spread on those investments goes down. Even worse, what if those investments stop paying you? Now you're paying a higher payment on your mortgage and you have no cash flow to support it. This is why that company's being sued. This is what I've warned people about for years. And voila, it's happening. And of course, now there's people that feel victimized and they're suing them now. So just be aware that this kind of stuff, again, a velocity banking in and of itself, theoretically, I think is a cool philosophy. Here's what I did. I even talked about this in 2020. If you were to go back far enough, you might even be able to find those episodes anymore because once you go past 300, Apple and Spotify, they stop showing those episodes. But back in 2020, here's what I was telling myself and a lot of my clients is I was pulling my equity out. I had a home equity line of credit. I maxed it out. I pulled out the max amount. Why? Because I was afraid the banks would take my credit line away. So I pulled out the max amount and left the balance higher. Now I still paid at least interest only, maybe a little bit more than interest only on the payment, but I wasn't trying to pay it down because I don't want them to cut that limit back. So I kept that money and instead had it liquid. And then I eventually did invest it too to create higher returns than what I was paying on my line of credit. That's how I used it. Now I still could get the cash out. I could still use that cash to pay it on a line of credit. That's the key thing. So that's velocity banking. I will just say, as a strategy, I'm not a big fan of it. I personally think that that strategy, although could work, I don't do it like what they do. I don't take all my extra paychecks to pay it down, which is what they always show you on those numbers. It looks sexy because they're showing you put every dollar towards it. I don't believe you should put every dollar into the bank's hands. I believe it should keep it in my control, which is why I use infinite banking instead. Because when I put into that life insurance policy, that money is liquid. That money is available. And the banks, or the insurance companies in this case, the insurance companies don't take that away because they know that money's guaranteed. They're not worried about high risk. They're not doing gambling like banks are. Insurance companies can't leverage more money than they have. So I actually use that strategy instead to keep my money liquid and available. And yes, I could even use that money to invest with and literally make money in two places at once. That's not really the case with the home equity line of credit, but that is the case with my infinite banking policy because it does pay me interest. Home equity lines of credit do not pay you interest. Whole life insurance policies pay you interest on the money that's still in there because you never pulled it out. You were using the insurance company's money to borrow and then lend out and take the cash flow and pay it back in. So therefore, we do pick up extra interest dollars along the way above and beyond what we're earning on the investments that we're doing. So that's what I prefer to use. And again, I don't even use that all the time. I use that for very specific types of investments. But my point is, velocity banking, infinite banking, not the same strategy. Again, for me, like in my house, what I did is I pulled out the max from my home equity line of credit and did not pay it down. Where with infinite banking, I put the lion's share of my cash to go there where I could protect that money, protect it from taxes, protect it from lawsuits of creditors, protect it in a sense of just making better returns or protecting it from inflation risk, right? Because the bank's not going to pay you much. I might as well put it somewhere where it's going to beat inflation. That's where I would put my money. And then, of course, that money doesn't just sit there, although we have quite a bit sitting there, but instead, I'm also going to use some of that money to invest as well. That's what I see as being different. So again, two different strategies, two different philosophies. Both can work, but I will tell you the one that I believe trumps every time is using infinite banking. Now, here's the advantage I will say for velocity banking before I let you go, is that velocity banking is good in the sense that you get money from the bank. You're getting equity from your house. Understand that infinite banking, you're using your own cash to go into that policy. So this is why I also pulled out cash from my home equity line of credit because the bank was giving me money off the equity, the asset of my property. That's not money that I'm using, I'm not working for. The hardworking money I have goes to the infinite banking, but the equity of my property comes from that velocity banking, or in this case, just the home equity line of credit. So there is an advantage to using both strategies. But again, I just don't believe in aggressively paying off your house. I think it's risky. If you are going to pay off your house, I think if you're going to do it in one lump sum check, do a fixed 30-year mortgage that you could refinance if rates drop, but at least you fix it, you lock it where those home equity lines of credit, the rates can go up or down, but they have been going up and that's been a risk. They haven't come down like people expected. So those things, all those uncertainties, I just don't like as much. I like to have a fixed 30-year mortgage, pay it down on a regular basis. And if I want to pay it off, great, but I'm not trying to accelerate paying off unless I have so much cash leaking out of my pockets, I don't even know what to do with. But that's just not the case because there's always investments, there's always opportunities, there's always great things to do. So, anyways, I'm not going to dive any deeper into this, but just to understand velocity banking, infinite banking, two different things. Velocity banking is home equity line of credit, infinite banking is life insurance. I prefer going the infinite banking route. If you want to learn more about that, go to our website, moneyripples.com. There's a whole infinite banking section. You can learn more there. Make it a wonderful and prosperous week. See you later.